It's a pleasure to welcome Claudia Ruiz Ortega from the World Bank, and she's going to present a paper entitled Related Exposures to Distressed Borrowers and Bank Lending, with a number of other co-authors, including Sumit Garbal, Ricardo Correa, Bernardo Moraes, and Jessica Roda. And the floor is you, and we agreed that we try to be within an hour, and we can ask questions in between.
Excellent. Thank you very much for the introduction. Thank you very much for connecting to this talk. So let me jump right away to the first slide. Let's see. Okay. So there is one big question that we want to answer in this paper, and this question is understand how are banks reacting when a large fraction of their borrowers is facing or faces a common negative shock. And more concretely, what we're trying to understand is how do banks that are more exposed to a sector, how are these banks responding when a negative shock hits the sector? And what we want to understand is if they scale back their lending when a sector is hit by a shock in order to reduce losses and diversify their loan portfolio away from this sector that is now in distress, or if in the contrary, they end up expanding more their lending to this sector to keep struggling borrowers afloat in order to contain losses and preserve the regulatory ratio. So this is more concretely what we're going to be zooming on. As for motivation, we see that there is limited regulation currently on related exposures to multiple borrowers. However, we do see while there are regulations on large exposures that set prudent limits on exposure to a single borrower, there is no concrete guideline on other types of concentrated exposures like sectoral, geographic. So this is it. It might be very difficult to monitor these exposures or whatnot, but this, as of now, this regulation is pretty limited. And it might be important to be monitoring these concentrations, no? And the reason we think it's important is that when a sector is hit by a negative shock, banks that are substantially exposed to this sector may end up failing, even if the regulatory ratios are strong, if these banks experience a simultaneous loss from firms in the sector. And these banks may not have the option to immediately recognize losses and scale back their lending, and may be forced to finance low-quality firms and low-quality loans. So this is a bit the motivation. So what we will do in this paper, we're going to exploit the global 2014 collapse in energy prices. This price collapse was an unexpected shock that ended up deteriorating the financial health of firms in the energy sector. And we're going to exploit this shock, and we're going to focus on Mexico. So in Mexico, we're going to examine banks that have varying credit exposures to the energy sector. And just a bit of context, Mexico is a large energy producer country. And what we think is very important of our context is that at the time of the shock and in the period that we studied Mexico, in Mexico, there were price controls on retail energy products. What this means is that even though the price collapse affected energy firms, these price controls help us clean a bit the shock or isolate this shock from non-energy firms, as non-energy firms in the market observed a price that didn't reflect this global shock. So we're going to study then again the responses of banks to this shock and how these responses vary by how exposed they were in their balance sheets to energy borrowers. Just a preview of the results. On the side of banks, what do we see for banks? So we find that after the shock, banks that have larger energy exposures prior to the shock end up experiencing a substantial financial deterioration. So we observe these banks have higher CDS and lower stock prices. We see these banks experience greater delinquencies. We see both that their risk-weighted assets go up and also their delinquency rates. These banks, however, maintain strong regulatory capital ratios. So their regulatory capital ratio never deteriorates. So these banks end up capitalizing. We find that they increase retained earnings. And importantly, I think part of our research is to understand what is happening with the overall lending of these banks. And we find that these banks end up reallocating lending into distressed energy borrowers. And this means that their overall lending is not changing. So we find that they are taking or contracting lending away from other sectors. So now let me briefly discuss the results.
Can I just ask a question? What does it mean that if you go back to the previous slide, what does it mean that they maintain a stronger regulatory capital capitalized by increasing the return earnings? So despite having all these exposures, they are able to make more profits or what?
No, so actually what we find, and I'll show you when we go to the results, we find that the profits go down, but we find that, like there's a decrease in their profits, but there's more retained earnings. So basically of the profits left, the retained earnings are going up, even so that to compensate what they were, the retained earnings that they had prior to the shock.
But why? Because they distribute less? Because they,
exactly. They distribute
invest less? Okay.
So our results suggest that they are distributing less to the shareholders.
And when you say greater delinquencies, what's the horizon at which you compute these things? I mean, I assume the stock market reaction is immediate or at the time of a shock, but the rest, like, what's the window on which you?
So 18 months after the shock, we start seeing greater delinquencies.
So
and this is actually, Helen, what we're doing also is monthly level data, right? So these months, exactly. Can you hear me well?
No, so I didn't get how many months after the shock you said?
So our data is monthly. Let me drop the video in case this helps me with the sound. So our data is at the monthly level. So I think I won't show you in this presentation the time varying results, but 18 months after the shock, we see the delinquency rates are starting to are increasing. So the post on average, they are experiencing higher interest rates 18 months after.
Thank you.
Okay. So then, just to continue to the results on the energy sector firms. So what we see is that after the shock, energy firms obtain laxer credit terms from more energy exposed banks. So what we see is that these laxer credit terms are in the form of larger volumes for working capital loans at lower interest rates and at longer maturities. And importantly, these laxer terms, we can see which firms in the energy sector are getting these laxer credit terms. And these laxer credit terms are going to firms that prior to the shock had larger outstanding loans with these banks, were in worse financial condition with these banks, and had maturity, and their loans were maturing faster. So this credit expansion to energy borrowers appears to be driven by attempts of banks to keep stressed borrowers afloat and thus prevent the realization of material sudden delinquencies in their balance sheets. And we rule out that this injection of lending to troubled borrowers is driven by the ex-ante financial health of these banks, by an informational advantage of these banks, by pre-committed credit lines, by internalization of negative sectoral externalities, as other research has found, or by political connections. So I'll go into more detail into these things. But basically, just the message here is that our results suggest that these banks are taking these or expanding this lending to firms in very bad financial condition to prevent deterioration of their balance sheets. As for the result on non-energy borrowers, what is happening to non-energy borrowers? So we see that after the shock, banks that were more energy exposed contract their credit to non-energy firms. This credit contraction mainly affects smaller borrowers in non-energy sectors. It's more pronounced for these borrowers, and especially for loans financing investment projects. Non-energy firms, we see, are unable to smooth this lending contraction from these more energy exposed lenders. We have real effects on these firms. We see what is happening with the real outcomes, and we see that the credit crunch that is happening with their more exposed energy lenders ends up reducing their lower real outcomes in the form of lower liabilities and lower revenues.
Claudia, sorry,
So,
before maybe you go to the next, but does that mean that they're doing zombie lending, or how credit worthy are these energy sector firms?
No, that's a good point, Elena. I think so. Yeah, I think this is where, one interpretation is that these banks are engaging, if not in some bill lending, some sort of evergreening, if something temporary, because at the end of the day, when this shock, after this shock, these banks, after some months, they are again, being more exposed to the energy sector. Some of these firms, perform bad on their loans. A lot of these firms are getting more financing. I think, I'm not answering your question. I think we are not saying if this is zombie lending, but it seems that it is zombie lending and it is evergreening. Yeah. So let me see if at the end I can get your feedback on this. But yes,
because I was wondering, I mean, from a welfare perspective, how good or how bad this is. Right?
Yeah.
I understand there are credit crunch for the non-energy firms.
Exactly.
Maybe these are worse borrowers. I mean, I don't know. Or, this is where I was coming from.
Right. So from our take on this is that this exposure is leading to a very negative impact, because you are contracting credit from healthy and non-energy firms. Healthy non-energy firms, especially smaller borrowers that tend to be more credit constrained. So this is, we think this is a bad outcome. On the other hand, it's also bad in the sense that banks are taking even greater risk. They are injecting more lending into a sector that is in a very uncertain point. So in the short term, this is very bad. How to, is in the long term, this is good or bad? Yeah, this is where we don't know. This would be useful to get your comments on this.
So can I just ask another informational question? So you said this was a negative shock because there was this unexpected change in the prices. I just don't remember, when did this turn around? I mean, is there some argument could be made the banks wanted to keep them afloat until the price?
No, we thought about this, but so this was a very uncertain period of time when this price, this global price took place. A lot of the energy experts said this is the new normal, because now with the, with the new drilling techniques and everything that is happening with the energy sector, so now we have to think of the shock of the price of oil as being very low from the near future. So it was the new normal is that now this is what the prices are going to look like. So at the time, the expectation was that this was not a temporary shock. So if let me then go on and see. I see where your comments are coming, and I think this is very useful. Let me show you what we have, and then let me know how you're connecting this to what I'm finding. So as for the outline of the talk, very quickly, I'm going to talk about the two literature bodies of work that we think we contribute to: the institutional background of Mexico, and on the shock, the energy market, the data, and then I go to the empirical strategy and results. So for contribution of the literature, I'm talking a bit on what you guys are pointing on. On one hand, there is this literature that documents who finance, so which lenders have a comparative advantage in financing distressed borrowers. And on this literature, mainly there is this take on the role of information. So usually there are some lenders that have a comparative advantage in financing borrowers that are in distress because they have better information on the sector, or because they have relationship lending, and this allows them to distinguish which are good firms that are going through a bad time. However, we show that lenders here, I think our contribution here is that we show that concentration of the portfolio of lenders seem to matter, as these lenders have incentives to extend credit to borrowers in these sectors, especially to weak borrowers in the sector, to maintain their regulatory ratios. The other body of work that we think we're contributing to is this research that is studying the incentives of distressed banks to finance weak borrowers. And this literature that is related to the zombie lending literature and to the evergreening of loans shows that poorly capitalized banks especially have higher incentives to keep weak borrowers afloat and delay or underreport their loan losses. And I think here our contribution is that we show that ex-ante healthy banks that end up having very large exposures to a negative shock, instead of using their capital to absorb losses, they raise more capital, take on more risk, amplifying the shock to firms in healthy sectors. So,
but there's also, I mean, whether the energy sector is a strategic sector, no, in Mexico. So it may not be only
yes,
the bank incentive. There may be a bit of leaning from the government, no. So how do we
totally
think about that? I mean, it may not
sure.
be the general result. Yeah.
No, sure. One question is, okay, is this all political lending or what you were saying, Elena, strategic sector in Mexico? So we do some robustness checks to see whether this is the case or not. For instance, we look at if domestic banks are behaving different from foreign banks, and we might think that domestic banks tend to be more prone to or more connected to the government and to be in line with, you know, rescuing the energy sector. We don't see any differences on that. We do another check to try to rule that story out. So basically, our results suggest that it's not these results are not driven by a type of strategic sector or political lending argument or explanation. But yes, I think one thing that, one challenge that we're going to have is that, especially in Mexico, given that energy is important, to whether these things that we're doing are convincing, these differences by foreign or domestic banks, if this help us to really rule out that this is what is happening. So I'll show you, yeah. So for the Mexican energy market, so here what we're plotting in the blue line is the evolution of the price of oil and the Mayan oil, which is the main product, energy product or oil product that Mexico produces. And then we're showing you the CDS spreads of energy firms in Mexico and in emerging markets. And so basically the messages from this figure is that to show that there was this big shock in oil prices around 2014, late 2014. The shock was big, a drop of 40% in the price of oil. The CDS spreads of energy firms in emerging countries and in Mexico spiked substantially. And just as we've been commenting, in 2014, by the time of this shock, Mexico was the 10th biggest oil producer in the world. The main oil producer in Mexico is a state-owned company called Pemex, Petróleos Mexicanos. However, another point connected to this, despite the importance of these Pemex, Petróleos Mexicanos, Pemex, when you look at the balance sheets of commercial banks, the Pemex represents only 10% of all the lending that commercial banks do to energy borrowers. So 90% of the energy, the lending of to energy of these banks is outside of Pemex, because Pemex mainly finances outside of the banking sector. So there is something that has to do, like banks are rescuing not Pemex, but other energy borrowers at the time of this shock. A second piece of information on the context that we are looking at. So again, the blue line is showing you the collapse in oil prices, and the red and green lines are showing you the retail price of energy in Mexico, no? And just showing you that there was this, regulated pricing of energy products in Mexico, gasoline, diesel, natural gas, and electricity, mainly remained unchanged throughout this time, basically shielding both consumers and non-energy firms from the drop in oil prices. And we think this is important for identification reasons, like we are able to identify a shock that is hitting the energy firms, while non-energy firms and consumers are somewhat shielded, right, by these price controls.
Some people are making lots of profit here. Who are making the profits?
So here the problem, if not the profits, for the government, right? All of a sudden the government is seeing the energy price, exactly. So this is the government has to keep. They have a lot of how do you say programs at place to kind of manage this volatility, no? So when the price of oil is very high, then the government has to put money. Public finances is taking a big hit. For the some checks that we do in the paper, for 2 periods after 2 years after this shock, we see that the public expenses are not being hurt. But at some point, there was a lot of news articles saying, you know, we cannot contain these price controls because it's really volatile and it's hurting our public finances. And actually, at the end of the period that we study, so about June 2016, they started lifting these price controls, no? So they now start, now in Mexico, the energy, if there's like a global drop in energy prices, consumers and non-energy firms will feel it. By the time of this analysis, it was on the government that took the hit.
But I mean, who is buying the oil wholesale and who is selling it retail? I mean, there seems to be a big rent there for the person who is doing that, whoever that is. You're saying it's not the government? I mean, who is the intermediary here?
So who is buying
I think what
oil?
Karen is trying to say, Claudia, if I understand her correctly, is that in this particular case, because prices drop, the consumer actually pay a higher price than in principle they should.
Exactly,
right?
to the government, and the government is keeping that money. Exactly.
Okay, so it's the government then that
Exactly.
takes the
Government.
money.
Yeah.
Exactly. And the opposite, no? When the prices are very high,
Exactly.
it is the government that is saving that amount.
Yes.
Mhm.
And then how long does the shock last? Because this ends in 2016.
So by when the price of oil recovers, right? That's your question.
Yeah.
So yeah, I don't have it in this figure. Yeah, I think if I remember well, after 6 more months, it started rising, but I should have a better picture. Yeah.
Now, also to understand the effect that Helen was asking you earlier on the 18 months that you said in terms of effects on lending, then basically whether it's the same length or shorter or longer than the shock itself.
Totally. Yeah. Thank you. Yeah, good point. Okay. No, this is being very useful. Thank you. Okay, so then let me get you another piece of information on how banks were before the shock. So here, what we're plotting the exposure to the energy sector in the x-axis. So this is the share of loans to energy firms over the tier 1 capital of banks prior to the shock. And on the y-axis, we're just showing the tier 1 capital ratio. So what we're seeing here is that, well, first of all, the financial sector in Mexico is bank dominated, and all commercial banks in Mexico are privately owned. So here we're not dealing with the state-owned banks. Second piece of information. So here in the figure, you can see the horizontal dashed red lines, which is marking where is the regulatory capital requirements. So prior to the shock, all banks met comfortably the minimum capital requirements. And you can see these by the blue circles, the solid dots. So these are the capital ratios of all banks. And here you can see that even though all banks are meeting these capital requirements, there is large variation in the exposure to the energy sector across these banks. And just like to a motivation of what this type of shock can do to the banking system, especially to banks that are more concentrated in energy sectors, we're doing in a simulated scenario, we're saying, okay, so what would happen if there is a generalized delinquency in the energy borrowers? So how would the regulatory capital of banks would look? And these are the red hollow dots. So here in a simulated scenario, a generalized delinquency in the energy sector can pose a problem because it can lead to a sharp reduction in capital ratios. No, so this is again a simulated scenario, but just to motivate that exposure might matter when there is this type of shock. And briefly, the data. So mainly we have data from three main sources. So this is balance sheet information of 28 commercial banks. We merged this information with Bloomberg to get the stock prices of these banks and the CDS spreads of the banks. We also have the information or data from the universe of commercial loans in Mexico from the Central Bank of Mexico. This is at the monthly level, covering up 1.5 million loans extended to 50,000 firms. And as for real effects, we're going to get information from Orbis. So this is information at the firm and year level, containing information on the balance sheets and income statements of a large set of Mexican firms. Very briefly, I just want to show you some like these are summary statistics at the bank month level, at the bank month level. Just two things from this table that I wanted to highlight. So first, the variation of energy exposure of banks. On average, 9.3%, the exposure was 9.3% of banks, 9.3% of as a share of their tier 1 capital. But you can see that banks in the 90th percentile had an exposure of 21.7%, whereas banks in the 10th percentile were not affected. They were not exposed to the energy sector. And the second point that I already made, in terms of capital, they were comfortably meeting their capital ratios, regulatory capital ratios. So some definitions to start to showing you the results. So to define which firms are in the energy sector, we're using the firm's industry reported at the 5-digit level to identify firms that belong to the energy sector. Ex-ante energy exposure of a bank, how are we defining it? We're using the definition by the Basel Committee on Banking Supervision. It's mainly the loans that are issued to the energy sector over the tier 1 capital of banks, and we're setting it to prior to the shock, August 2014. And the other piece of information is when we compare banks before the shock, these banks are very similar. The only different banks that are more exposed or less exposed to the energy sector don't vary in many other things. So here, for instance, this is prior to the shock. And here you can see in the last column, the t-test comparing whether there are differences in their means. So here you can see in terms of their CDS spreads, stock prices, the loan portfolio, how big these banks are. These banks seem pretty similar, no? The only difference that is by mechanically is how exposed they are, because we're different here. We're comparing the low exposure versus the large exposure banks. So
when you talk about exposure, is it net of any derivative position that may they have to hedge against energy prices, or it's
no, actually no. It's so it's as I described it. No, so we look at the amount of the volume of loans to energy sector over the tier 1 capital of a bank.
Okay, so you don't have the data to know if they are hedged one way or the other, right? I mean,
no,
okay.
no, we're not using that. We're not using that. Why do you ask this, Helen?
No, I mean, if some banks have a lot of loans to the energy sector, but at the same time, you know, they are
somehow insured,
some hedges to try to cover at least partly for the risk of these bank of these bonds. So that would matter, right? For the...
No, that's a good point. No, we don't. We're not using that. We're not using that. In the results, it seems that they are responding. Let me show you the results and then we can come back, but we're not using that. We don't know if they are hedged or not. So here, let me start showing you some data.
Before you continue, just did I understand correctly that there are no differences? So they are statistically indistinguishable. So the fact that one want to be 20% exposed to the sector rather than 10, it doesn't depend on how capitalized it is.
No, we don't find that. No,
nothing.
No, we don't find that. So what is driving some banks decide to channel more loans to energy? We, in the main variables of interest, that's a good point, no? Why a bank would specialize? This is not that they, specialize in energy, but like why banks hold 21% of their capital in energy loans, no? We don't see that this is driven by the size of the bank, by the capital of the bank. So here you are worried about the unobserved, Helen?
I mean, it's not that I'm worried, but I'm just wondering what is it that drives, because 10% difference in, and if 10 is the average and 21 is the maximum, means that the banks that are way less than 10%, right? So, so 20% difference or 15, whatever it is.
It's explained by what?
Is quite a significant
right.
difference. So the fact that nothing explained this is
that is not explained by the size of the bank. Right. Let me.
Can I just, related to that, could you look at other at loans to other non-energy firms in order to sort that out? I mean, is it basically the story is they're just looking for good loans and they don't look at the industry, and happens to be some are in energy?
So say that again. So basically, the concern is that banks are specializing in energy, and
no, I'm saying the opposite. I'm saying, could you see if it's not that they're specializing in anything, they just happen to be, you're just
I see what you say.
That happen to be, you know, they're just looking across the population of people looking for loans, and then they happen to be exposed. I mean, it seems like you're only, if I understood correctly, you're only focusing on bank loans to energy firms.
Exactly.
Sort of the standard corporate financing would be take a control where you're looking at loans that are not, you know, energy. I was just wondering if you.
No, that's a good point. Yes. So again, I think given that this energy exposure is not explained or is not driven by different, you know, size of banks or this other capital, we have always thought of this as, okay, so banks are, yes, no, I think I don't have a good answer of why then is explaining these differences in exposure. And I think on the second question, this is something that we're going to be using in our identification strategy. So let me show you. So let me show you this figure, and then we'll go to the methodology. So basically, so this is again just showing in the raw data what happened in the shock and how banks. So here we're going to be comparing banks below the median exposure prior to the shock with banks above the median exposure prior to the shock. So here what we see is that the energy price shock impacted negatively the financial variables of banks that were more exposed to the energy sector. And importantly, so let me show you. So on the first figure, you can see that on terms of the CDS spreads of banks, so after, even if before the shock, the dynamics were somewhat similar, after the shock, you start seeing this divergence, no? So there's more financial distress for more exposed banks. In terms of their stock prices, similarly, you do see a deterioration on their stock prices or for banks that were more exposed to the energy sector. And in terms, for me, very, very surprising was the last figure, no? So what is happening to the share of loans to the energy sector? So even though these banks had larger on average exposures before the shock, these exposures had similar trends. They were pretty constant. But after the shock, very, very soon, you start seeing this exposure increasing for banks that were more exposed to the energy sector. So let me then tell you what we're doing. So first, let me show you. So the first exercise that we do is, okay, let's only focus on banks, not yet on firms, just on banks. And we will see these things, these outcomes that I showed you in the raw data. We're going to use regression analysis to try to quantify these magnitudes. So we're going to relate the outcome Y of a bank B at a month M to the exposure this bank had prior to the shock to the energy sector. And we're going to, it's a difference in difference. So we interacted with this time dummy of post the shock. And we're going to be using month and bank fixed effects. So when we run this regression, so what we're getting is that banks that were more exposed prior to the shock, after the shock, again, it's the first are showing what I explained you graphically. So we do see that these banks are increasing their CDS spreads. They are dropping, or the stock prices of these banks are going down. in terms of their loan portfolio, these banks are not shrinking. We have a null effect here. They are not changing their loan portfolio, but they are increasing their energy. You see this in column 4. The share of loans to the energy sector is expanding. In terms of delinquency, so this is again also, why is it, if it were, for instance, Pemex, everything driven by, these firms, we wouldn't expect these firms to be delinquent because these are like government firms, but we do see energy firms, or we do see a delinquency increasing in the balance sheets of these banks. We also see these banks having more risk-weighted assets. These risk-weighted assets are increasing for these banks. However, we do see the Tier 1 capital and the capital ratio of these banks increasing. So how to interpret these coefficients? As this energy exposure is continuous, we have to look at a 1 standard deviation increase. No? So here we see that a 1 standard deviation increase in a bank's energy exposure is associated with a 1.2 percentage point increase in exposed exposure to the energy sector, is associated with a 0.15 percentage point increase in delinquency rates, and a 1.9% increase in risk-weighted assets, and a 3.3% increase in Tier 1 capital, and 0.16 percentage points increase in capital ratios. So in terms of regulatory capital ratios, these banks are not doing bad after the shock.
So why do you have such a different number of observation between the stock price, the
columns,
and the data on loans and etc.?
Yeah, that's a good point, Helen. Let me see. I think we don't have this information for all banks, but I'll check this again.
No, but
you should have at least the return on assets, right? Or the return on equity. It should be there. Because
and the return,
So, I mean, it's not if you don't have.
So why the 2 columns?
Price.
So you mean why in the 2 columns I have less observations, right?
Yeah, so CDS, maybe you don't have CDS, you know.
Yeah, you may not have
banks,
CDS for all banks.
But the stock price, I mean, or at least, or you could have a return on equity or a return on assets.
Exactly.
But the stock price seems like you should have it, no?
Exactly. No, you're right. Let me check number of observations. Yeah, thank you, Elena. Okay, yeah. Okay, so
sorry, Helena, how many observations would you like to see? Because of course, loans, delinquencies, and so on, the rest of the column should have a higher observation, right?
From the first 2?
The RWA as 612, so I would like to see the same, no?
So what, Helen, if I understand correctly, is you say, even if you don't have the stock prices for everyone, at least use another measure like the ROA that you have for all banks.
How many banks do you have in your sample?
28 commercial banks. So this is monthly data.
But I don't see why you don't have, the stock price seems like a very available.
That it should be. Let me check. Thank you. Okay, so then let me zoom. The last piece of information that I showed you in this table is that the capital ratio is increasing and that the Tier 1 capital is going up. So here I'm against repeating this first column. So the Tier 1 capital of these banks is increasing. And then we're trying to understand the elements of this, the capitalization of banks. No? What is driving this? When we look at paid-in equity, we don't see that paid-in equity is changing. The earned equity is going up, and related to what Elena was asking at the beginning, the earnings and the profits of these banks are falling. However, the earned equity is increasing and is statistically significantly increasing. So our interpretation of these results is that despite declining profits that these banks are getting after the shock, these banks are able to increase their Tier 1 capital through retained earnings by cutting dividends among shareholders. Does this interpretation, Elena, sounds accurate to you?
Yeah. Yes.
So this is to answer the question that you raised at the beginning. Let me now move to how we're tackling trying to understand, so banks are injecting more money into the energy sector. How do we disentangle how they are doing it? So the first thing that we do is look only at the energy sector, no borrowers that are in the energy sector, what is happening to their loans. So what we're going to do here is understand what type of loans and borrowers tend to receive more credit. And to do that, we're going to run, again, a difference in difference approach, where we compare banks that are more exposed to the energy sector prior to the shock with those that are less exposed. And here we're going to start using loan level data. No? So here the outcome is going to be for firm F, bank B, and month M, only for the sample of firms that are in the energy sector. So we're dropping all the non-energy sector firms and zooming on energy loans. So here, importantly for identification, so first we're going to have these fixed effects to control for firm bank variation, but in some specifications, we're going to saturate these specifications with industry times state times month fixed effect to try to control for the demand changes in the demand of this for credit for these firms. And in some others, we're going to also use the firm month fixed effect identification, or strategy. So what do we see with these loans, loans to the energy sector? So the first thing that we see is that banks that were more exposed prior to the shock, after the shock, begin providing or issuing loans with larger volumes to firms in the energy sector compared to banks that were less exposed. So the volume is increasing. What type of loans are increasing their volume? Mainly, we see this effect for working capital loans, not for investment loans, which makes sense. These firms are struggling. So basically, probably what they need is more liquidity, not like loans for longer terms. In terms of the margins, we see that the interest rates on these loans is lower. And in terms of the maturity, we do see that these loans tend to come up with a higher maturity. So if I show you here how these results look on a monthly basis, here we are comparing, again, banks with more and less exposure. So we do see here is in terms of volume. So we do see that volume right after the shock begins increasing if you are a borrower of a large exposed bank relative to borrowers from low exposed banks. Okay, so what is our conjecture? So our conjecture is that energy exposed lenders are loosening credit to customers that represent a large immediate expected loss while increasing capitalization. This we read from the results that we got at the bank level. However, okay, if this mechanism is at place, credit expansion, so if this is happening, then we should expect this credit expansion to be greater among certain borrowers. And the three characteristics that we're going to study is first, what is happening with borrowers, energy borrowers that prior to the shock had larger outstanding loans. Why? Because these borrowers represent a larger share of the balance sheets of more exposed banks. So this we're going to calculate an indicator for large borrowers, which of these borrowers represents a larger share of the balance sheets of a bank. We're going to look at borrowers that have a higher threat of default. So we're going to look at the ex-ante risk of a borrower. So the risk rate that a bank assigned to a borrower prior to the shock. And we're going to see if borrowers that were considered riskier are getting more of these loans. And then we're also going to look at borrowers that have loans closer to maturity. And this is going to be calculated with this variable maturing loan. So all these three are dummies. And what we're going to do is interact these dummies.
Can you give a bit maybe more background on, how many firms are there in the energy sector? Is it a very concentrated sector? We have a big firm and small firms. We have several oligopolistic firms. And do we have each of these firms borrowing from many different banks, or specialization, one firm, one bank type thing, main bank? Presumably you would keep lending if you have a specific relationship with a big firm, you would keep lending only to that big firm and not necessarily to the other ones. I mean, what do we know about this kind of ties, between bank and firms and the size of firms?
No, I think what you say is correct, this relationship lending. So here in the presentation, I didn't include this information. I think in the paper we do have this. However, Helen, yes. So here what you want to know is if all energy firms are big, that's kind of what you're thinking? Or how is the distribution of...
the structure of industry. Do we have one big energy firm? Do we have several? Do they borrow from several banks, or do they have specific relationships between some banks and some big firms.
Mhm.
In which case you would expect, the lending to be geared towards the big firms on your balance sheet, but not necessarily to the other ones. I mean, so it would be good to know a bit more about the structure here.
Yeah, thank you. I think we don't have the this information very distilled, but I think we can definitely provide this information. It is not the case that it's only one big firm and this big firm is getting all the loans from a bank. Like, we do have a lot of variation in terms of size. We do have, so we do a lot of checks to rule out if it is like relationship lending. So some checks that we do is actually to see which so what we do is say, okay, if we identify firms that tend to, before the shock, tend to get their finance mostly from or more likely for one bank. But then we see that even for these firms that we identify them as having a relationship with one bank, which bank saves them after the shock? And we see that if these firms have two banks, even if one bank is the one where they have a stronger relationship, if the other bank has is more exposed to this firm, the bank that is more exposed is going to also provide a lot of financing to this firm. So I think, to answer your question, I don't have the numbers. I think it's not only driven by one firm, but it seems that our mechanism, our checks suggest that it is not driven by relationship lending or by only one bank providing credit to very big firms. Let me show you the.
But I don't quite understand what you mean by relationship lending. I mean, if a bank is very exposed to a firm, okay, but we have a relation, and it seems like your mechanism should apply very much to that bank firm relationship. I don't know why you want to rule out relationship lending. Yeah, seems to me it's your mechanism. You are very exposed to a firm, then you are lending to that firm a lot, and you are actually. So I don't not sure I understand why you want to rule that out, or what you mean.
Rule that out.
And how you actually oppose in your measures relationship lending versus exposure. I don't know how you differentiate the two, and what. So I don't fully get it here.
So I think what we do to measure exposure, it's how big a firm is for the balance sheet of a bank, and to measure. So what we did is look at the opposite. No, for a firm, if 90% of your loans are with a bank and the other 10 are with another bank, then that is showing which is your main lender. No. That's how we wanted to see if it is driven. I understand that it's a fine line, no, with from relationship lending and exposure, but so what we wanted to understand is if firms obtain more financing from a bank, this is the bank that knows them better because most of their financing come from this bank. Are these the banks that are saving these firms? So this is how we're trying to distinguish these two, Helen. The other thing that we do is for relationship lending. Let me move on and I'll come back. But I agree, like here, this is where, okay, so how to distinguish one mechanism from the other, right? Let me show you what we have. I think our results suggest that this is not relationship, and I'll show you why. Let me go over the tables. So the first one is, remember, this indicator on whether the firm is represents a larger borrower in the bank's balance sheets. So what we see is that banks that are more exposed to the energy sector will tend to provide even more financing for firms that represent a larger fraction of their balance sheet after this shock. So this, we see it in columns 1 and 2. And these firms are likely to receive a larger or laxer terms. If not the resulting interest rate, it seems that they are getting lower interest rates, but it's weakly statistically significant. However, we do see that these larger borrowers are getting more maturity on these loans. And this on risk. So what we see is that banks that are more exposed to the energy are issuing loans of larger volumes to firms in the energy sector, but especially to those firms that prior to the shock had a lower rating, no? So were considered riskier. So these firms are obtaining larger amounts of loans. They are getting, especially again for working capital, so short-term loans, or this type instead of investment loans. So and then in terms of interest rates, even though they are not dropping the interest rates, they are extending the maturity of these working capital loans, so probably giving them more time to not default to these firms. So this Helen, I was also thinking that this might also suggest that if we think of, if it is a relationship lending, usually you would expect that relationship lending, as I think of it, is banks know their customers and can identify that a customer is good, and then they are willing to, you know, help these distressed borrowers in a bad time because they know they are good. But in this result, I think we're finding the opposite, no? So banks, they don't seem to be injecting more credit or issuing more laxer loans to their good borrowers. They seem to be issuing larger loans to borrowers that were at risk of default before. So this is how,
yes, but the question remains whether, I mean, the fact that they are the riskier ones doesn't mean that they're not credit worthy.
Correct. Yeah.
So it depends on whether they are credit worthy overall, because I can also understand that banks may help more the weakest, but it depends how weak they are.
Exactly. So it's relative to, okay, yeah, that's a good point. I understand what you're saying. Yeah, perfect. Let me write this down. Thank you. Excellent. Okay, in the third check that we do, so what happens with energy borrowers that prior to the shock were soon to, you know, their loans were soon to mature. So what we see is that for these borrowers is where we see that the amount issued is expanding, and especially the interest rate is also going down. So it seems that for these borrowers, there's a specific, we also see a more laxer terms flowing to these type of borrowers. So yeah, and unfortunately, I think it would have, after this discussion, it would have been nice. I didn't bring the tables where we showed these other, the rule out of these other explanations, but given the discussion, it would have been nice to include some. What we do see, we rule out that bank lending increase to the energy borrowers is driven by bank capitalization. So even after we control for bank capital, we see that our results come through. Also, we see that prior, the bank capitalization of these banks was as good as banks that had low exposure. Informational advantages. So what we think, the way we interpret our results is that this doesn't seem to be driven by information, because banks appear to be giving these loans to borrowers that were riskier, but I agree on your point that that doesn't mean they are not credit worthy. And second, we also interpret these findings as well. They are giving these loans to firms that are maturing, that their loans are maturing very soon. So, and for firms, that are big in their balance sheets, right? So for us, this was the way to rule out informational advantages. I don't know if this is something that you think it's convincing. There is this literature on the third bullet point that talks about the internalization of negative spillovers. So think of lenders that are very big for an industry. An industry depends on a given lender. These lenders have incentives to rescue firms when the industry goes or is in a bad time, because firms in this industry are going to need financing. So for these banks, they have incentives to internalize spillovers. This doesn't seem to be the case in our setting. The reason for why is that we see that these banks only finance their borrowers that prior to the shock were having outstanding loans to them. These banks are not issuing new loans to new energy borrowers, only to their to borrowers that had outstanding loans with them. We also rule out that our results are coming from committed credit lines, where like credit line drawdowns from previous loan commitments. We know that they increase in bad times. There are papers showing this. In our case, this is not coming from credit lines. It's coming from new loans that are being issued after the shock. We also are trying to rule out political connections. So here Clearly, we have these big players and the energy sector being a strategic sector in Mexico. But again, all commercial banks in Mexico that we have in our sample and in general in Mexico are privately owned. We have a big share of foreign-owned banks, and we don't see that the results are different from foreign-owned and domestic-owned. Basically, banks that are very exposed are the ones injecting more loans to the sector, regardless of their nationality. And the last part of the paper, what we do is, okay, so we document that these banks are reallocating more lending into the energy borrowers. So where is this lending coming from? We see that in the first part of the paper that the overall lending is not changing of these banks. So then it means that non-energy firms are being cut from credit, no? So basically here we want to see if non-energy firms are less likely to obtain bank credit from these banks, and if so, which borrowers and types of loans are more affected. And given that we have real outcomes, we want to study if this decline in lending is also translating in declines in the real activity of these non-energy borrowers. So when we do the same, now what we're going to do is restrict our universe of bank loans to the loans that are being issued to firms in the non-energy sector. So the first thing that we see is that the banks that prior to the shock were more exposed to the energy sector are reducing the volumes issued to non-energy borrowers. And this reduction in volumes are not coming from working capital loans, but for investment loans. So they are less likely to finance investment loans of non-energy borrowers. When we look at heterogeneity of which borrowers are getting this contraction in lending, we see that the majority or more, that this contraction is more pronounced for smaller borrowers rather than large borrowers. And finally, given that we have real outcomes, we investigate if non-energy firms can smooth the lending contraction from their more energy-exposed banks by switching to alternative lenders or sources of financing. And what we're going to do is we're going to aggregate our loan level data at the firm level and create the variable energy at the firm level as the weighted average of the energy exposure of all banks that were lending to firm F in September 2014. And we are going to be doing the same, but at the municipality level. So we know where the firms are headquartered, in which municipality, so we can know how exposed are the branches of the banks in that municipality to the energy sector. And when we do that, we see that firms that are headquartered in a municipality where the bank branches are more exposed to the energy sector, after the shock are getting, and this is information already from Orbis, so they are getting loans of lower volume, and they are also reporting lower investments, lower liabilities, and lower revenues. So I think right on time, and very curious to hear you. You've given me a lot of feedback, so let's see how you see these results. But the conclusion of this work, no? So we're using credit registry data from Mexico, exploiting the fact that Mexico has these energy price controls, and we exploit the 2014 collapsing global oil prices, along with variation in the exposure of banks to the energy sector. And we document that more exposed banks respond to the shock by increasing their short-term lending at lower interest rates and longer maturities to energy borrowers. It seems similar to an evergreening strategy, whereby more exposed banks are subsidizing credit to troubled borrowers, especially those that represent larger potential losses in their balance sheets. And while more exposed banks eventually increase their capital, they end up with larger exposure to this troubled sector. Why? Because they are shifting lending away from borrowers in other sectors, and then they seem to be amplifying a sector-specific shock to the rest of the economy. And non-energy borrowers, we find that they don't smooth this lending contraction, and these non-energy borrowers that are prior borrowers of more exposed banks, if something, are doing worse in their real activity, in their real outcomes. So let me stop here, right on time, and curious to see your thoughts.